Welcome back to Investing Talk Podcast. Today we're tackling Datadog. Is it this AI-powered infrastructure powerhouse that really deserves its, well, sky-high valuation? Or is it maybe a high-growth favorite that's potentially close to a correction? We've gathered some comprehensive sources to help us unpack this, looking at everything from financials to market position and, yeah, the potential risks too.
It's definitely a fascinating picture. Always is with these kinds of growth companies, isn't it? But we'll break down the key insights, try to give you a clear view of what the experts are pointing towards. The goal really is to provide a balanced perspective. You got the opportunities, yes, but also the things you really need to consider with Datadog.
Okay, and before we really get into the weeds here, if you find this sort of detailed analysis helpful, please do think about subscribing, maybe liking the video, commenting. Your support genuinely helps us keep bringing these analyses to you. And hey, if you feel we've provided some extra value today, you could even consider buying us a coffee. Every little bit helps us keep the lights on. All right, so let's get right into it. The overall assessment we're seeing gives Datadog a 7.0 out of 10. That comes with a BUY recommendation, but, and this is key, with caution. That feels a bit like having your cake and eating it too. What's really driving that mixed message?
It's interesting, right? Because it sends two signals at once. On one hand, Datadog looks like a frankly compelling long-term investment. You've got exceptional growth fundamentals, really strong market positioning, robust financials. I mean, things look good on paper. But then the other side of the coin is the current price, floating around $155. That price already seems to reflect really high growth expectations. And then you look at the technicals, the charts. They also suggest maybe pumping the brakes a bit in the near term. Could limit the short-term upside. It's that classic growth stock dilemma, balancing the excitement with, market reality.
Okay, so let's unpack the buy part first. Despite the caution, what makes Datadog such a strong contender for the long haul? What's the core story?
Well, if you zoom out, it boils down to really incredible growth and pretty clear market dominance in a crucial area. Datadog's revenue growth has been just outstanding. Take 2024, they hit $2.68 billion. That's up 26% from the year before.
Wow, 26%?
Yeah, and that momentum didn't fizzle out. Q1 of 2025, they pulled in $762 million, still up 25% year over year. So it shows this consistent, pretty significant expansion.
That is impressive consistency. But what about their position in the market itself? It's getting crowded, isn't it?
It is, which raises that key question. How strong is their actual competitive position? And the answer seems to be very strong. They're in the rapidly expanding observability market. Think of it like giving companies visibility into their complex software system.
Right, seeing what's actually happening under the hood.
Exactly. And as everything moves to the cloud and gets more complex, that visibility becomes absolutely critical. And Datadog, they've been named a leader in the Gartner Magic Quadrant for observability platforms for 4 years straight. That says something.
4 years. Okay.
Plus, the whole market cloud monitoring is projected to boom, expected to hit something like $9.37 billion by 2030, growing at over 21% a year. So they're leading in a market that's really taken off.
So what gives them that specific edge? You've got competitors like Splunk, New Relic, Dynatrace. How do they stay ahead?
Good question. Their advantages seem pretty clear when you look closely. First, it's that unified platform. They bring together metrics, logs, traces, security, all in one spot. That's a big deal for simplifying things for customers.
Instead of juggling multiple tools.
Precisely. Second, integrations. They boast over 700 of them. Means they can plug into almost anything a company's using. Then there's their AI stuff, like Watchdog. It uses machine learning for smarter alerting, finding problems faster.
The AI angle.
And finally, that land and expand model. It's really effective. They get a foot in the door with one product. And then, as the customer sees the value, they sell them more and more across the platform. High retention, high expansion within existing accounts. Super efficient.
That land and expand does sound potent. And the financials. Beyond revenue, are they actually making money as they grow? Profitability matters.
It does, and that's another positive trend. Their profitability is improving significantly. Gross margin, for instance, hit nearly 81%, 80.8% in 2024. Shows they have pricing power.
That's a healthy margin.
Very healthy. And even better, their operating margin turned positive in 2024, about 2.0%. That's a big shift from being in the red before. Shows they can scale efficiently.
Okay, so they are turning growth into profit.
Seems like it. Plus, solid customer growth. They now have 3,770 customers paying them over $100,000 a year. That's up 13%. These aren't just flashy numbers. They point to a fundamentally healthy, growing business.
Okay, so we've painted this picture. Booming market, clear leader, improving financials sounds fantastic, which brings us squarely to the caution part. Because that price tag, wow, let's talk valuation, those numbers are high.
They are indeed very high, and that's really the crux of the caution argument. You look at the PE ratio, price to earnings, it's at 330.1, just stratospheric.
330 compared to what, maybe 20 or 30 for a more standard company?
Right. And the PS, price to sales, is nearly 20. Price to book is over 20 as well. These are seriously elevated metrics. They basically scream that the market is pricing in massive, massive future growth already.
So how does anyone justify paying that? Or maybe, how do investors justify it? Is there a logic beyond just hype?
It's a fair question.
Huh?
And while the numbers look extreme, they do sort of align with other really high-growth soothe platforms, especially in this observability niche. The justification tends to revolve around a few things. That recurring revenue model, it's sticky, predictable income.
Subscription businesses are prized.
Highly prized. Then there's the market leadership we talked about, and those improving unit economics, the better margins. Investors are essentially betting that Datadog will dominate this critical infrastructure space for years to come, and they're willing to pay a big premium for that potential future.
So it's a bet on long-term dominance, essentially. Okay, beyond the fundamentals and valuation, what are the technical signals telling us? Is the chart flashing warnings too?
The technicals definitely add to the cautionary tale, at least in the short term. The 14-day RSI, the Relative Strength Index, is up at 84.4. Generally, anything over 70 suggests a stock might be overbought, maybe due for a pullback.
84 is quite high.
It is. Means the prices run up very fast. However, another indicator, the MACD, still looks bullish, suggesting underlying upward momentum is strong. And the stock is trading well above its major moving averages, 50-day, 200-day, which usually signals a strong overall uptrend.
So mixed signals from the technicals too.
A little bit, yeah. Strong momentum, strong trend, but looking potentially stretched or overbought right now. I mean, look at the last 3 months, the stock returned nearly 80%. Probably fueled by those strong Q1 results and the S&P 500 news.
Right, the S&P 500 inclusion. That's a big deal.
It is. So momentum is strong, but the technicals whisper maybe cool down a bit soon.
Okay, let's talk about those recent catalysts and what's coming up. What exactly has been pushing the stock lately, and what should investors be watching for next?
Well, several positive things have happened recently. That S&P 500 inclusion, set for July 2025, definitely drove institutional buying.
Yeah.
Index funds have to buy it.
Creates automatic demand.
Exactly. Then those strong Q1 2025 results, beating revenue estimates, show they're executing well. They've also been innovating, especially in AI. They launched new AI agents, BITS, AI SRE, Dev Agent Security Analysts at their big DASH conference.
Making the platform smarter.
Right. And they've made some strategic acquisitions too, like Eppo and Metaplane, to bolster their platform capabilities in data analytics and monitoring.
And what about the analysts? Are they still bullish despite the high price?
Broadly speaking, yes. The consensus rating is still a buy.
Yeah.
But here's the interesting bit. The average analyst price target is around $143. That's actually below where the stock is trading now.
So they like the company, but maybe not the current price level.
That seems to be the implication for the average target. Though you do see recent upgrades, like Wolf Research bumping them to outperform with a $150 target. So some still see upside even from here.
Okay, looking ahead. What are the key upcoming things investors should have on their radar, short term and longer term?
Short term, say the next 6 months, all eyes will be on the Q2 2025 earnings. That's expected around August 6th. People will want to see if they hit that $791 million revenue guidance and what the outlook is.
Guidance is always key.
Always. We'll also see the ongoing impact from the DAH conference, our customers adopting those new AI tools, and the S&P 500 effect continuing. Longer term, maybe 12 to 24 months out, it's about the bigger picture. The expansion of the AI market generally should help them. Their international growth, like the new data center in Australia, is important for tapping new markets. And watching that cross-selling metric, now over half their customers use 4 or more products. Seeing that number grow shows the platform strategy is working.
Lots to watch. But let's talk risks again. We know valuation is the big one. What else could potentially trip Datadog up?
Right. What are the potential potholes? Valuation is definitely the highest risk. That PE over 330 just leaves no room for error, any stumbling growth, any margin pressure.
And the stock could fall hard.
Potentially, yes. Competition is rated a medium risk. They face serious pressure from the big cloud providers, AWS, Azure, Google Cloud, who offer their own monitoring tools. Plus, established players like Splunk and New Relic aren't standing still. It's an intense space.
And the technical risks.
Also medium because of those overbought conditions. A 10% or even 20% correction would be shocking from a technical standpoint just to cool things off. Broader market risk, just volatility in tech stocks, is always there. But the actual risk of their growth slowing dramatically is seen as low right now, given their track record.
Okay, so putting it all together, the amazing growth, the leadership, but the scary valuation and technical warnings. What's the final verdict? What's the strategy?
The final rating lands at that 7.0 out of 10. Translates to BUY with strategic timing. For long-term investors, people looking out 12 months or more, it's still viewed as a strong buy. But the advice is, don't just jump in blindly. Consider dollar cost averaging, especially on pullbacks. Maybe below $140 would be ideal. Up to $150 is seen as acceptable.
And manage risk.
Definitely. A suggested stop loss around $120. And maybe allocate only 2% to 4% of your tech portfolio to it, acknowledging the volatility.
And for shorter-term traders?
The advice there is more cautious. Maybe hold off or just hold if you own it. Wait for that RSI to cool down, maybe get below 70 before thinking about an entry. A target tree range for them might be more like $130 to $140 with a tighter stop loss near $125.
Got it. And what about price targets going forward? Where might this be headed?
The 6-month target given is $165. That feels a bit conservative given the recent run-up and the technicals. The 12-month target is more ambitious, ranging from $180 up to $200. That assumes continued strong growth and market expansion.
With that $120 stop loss still in mind.
Exactly. And the key things to keep monitoring are those Q2 earnings on August 6th, revenue growth, margins. Also, keep watching the growth in those big $100 K plus customers. And of course, keep an eye on the competition and those technical levels, particularly the RSI.
So the bottom line seems to be Datadog is a really high-quality company in a great market, a growth machine. But that current price tag demands patience, discipline, and probably some strategic timing if you want to get in.
That sums it up well. Long-term folks might look for dips to build a position carefully. Short-term traders probably need to be quite cautious right now because of how stretched things look technically. It really comes down to matching your own investment timeline and risk appetite to what the market is telling you right now.
It really is fascinating, isn't it, how Datadog's success is so tightly linked to this explosion in cloud complexity and AI analytics, this whole intense focus on observability. It makes you wonder, what does it signal about just how complicated our digital world is becoming, and maybe how much we're going to need AI just to understand and manage it all going forward? Something to think about. Well, that's all the time we have for this deep dive. Thank you for joining us on Investing Talk Podcast. We'll be back soon with more insights for you.